So then when you're seeking clarity in this world, and the world is actually the most simple it's ever been, money in, money out, that's it. Then what you want to do is own the assets that rise the most and outperform that, which happens to be crypto and technology. So if we look at the last time we went through this point, which is the turn in the cycle, which is where we are today, that was December 21st, I think it was, 2018, when the Fed paused, which is roughly where we're getting to now. The market already knows this. It can see it coming. We're already having a banking crisis, all the signs of we need to stop. And what happened after that over the next year is the S&P rose about 15%, the NASDAQ rose about 25%. What I call the exponential age stocks, they rose about 35%, 40%, and crypto did, well, at one point 300%, but end of the year up about 100%, which is truly extraordinary. I've also then shown that crypto is all the same thing. So if I use the same global liquidity index, it's basically chart Bitcoin, but Bitcoin outperforms in the up cycles because there's a network adoption model, which is why it does so much better than almost all other assets. So that's the everything code, is the fact that it's all down to one simple thing, and I think it's forecastable, and in which case we know the price of assets in advance, which is a little bit freaky. And I know that sounds somewhat arrogant, but it's a hypothesis that I'll test, but I'm pretty sure it's going to be right, unless something changes.
Real Vision founder and CEO Raoul Pal has developed a single investment hypothesis called the everything code, which condenses his 20 years of investment and macroeconomic experience into a simple idea that money goes in and out. According to Pal, the world runs on interest rate cycles, lasting around 3.5 to 4 years, that involve increasing interest rates and monetary tightening, followed by a pause, then cutting interest rates and further monetary stimulus. Pal's everything code suggests that we have just come out of the bottom of a liquidity cycle and predicts that cryptocurrency and technology stocks, as exponential assets with adoption effects, are the best assets to invest in at these points. Pal believes that Bitcoin, Ethereum, and cryptocurrency, in general, will continue to outperform other assets due to their more exponential and network adoption model, as shown by past market cycles and his global liquidity index. Pal even suggests that asset prices can be forecasted up to 18 months in advance, which he plans to test.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I'll start with the everything code because that's where we are today, and a bit into the future, the exponential age is where we're all going. The way to calculate GDP is population growth plus productivity growth plus debt growth. Those are the three large factors that define how GDP moves, the wealth of nations. We have for a long time, and it's been the observable macro trend of my lifetime or my working career, is that we have been in a slowdown in population growth globally. So an aging demographic. So that has meant we have seen lowering GDP over time. Trend rate of GDP has been falling. For the earlier part of that trend, so we're talking about the 80s, 90s and early 2000s, answer to that was increasing debt growth and hoping that a productivity miracle was going to come along. Even though we had the advent of the computer, the internet, mobile phone, everything in that period of time, we actually didn't increase productivity per capita. And that's more of a function of the aging demographics. So demographics is the big secular issue that society faces. Now, over that period of time, going back a little bit further, there's quite a lot of moving parts here, but going back further, that baby boom generation all came into the labor force at the same time. It caused the inflation of the 70s as you put the largest bulge in population in all recorded history into the workforce and into the consumption force at the same time. They went out and bid for their first housing, first cars, first everything else. We had some supply shocks, and before you know it, we had structural inflation. But another thing happened is that it came into the labor force. When you put 76 million people all of the same age in the labor force, they compete with each other for jobs. And real wages never went up again, ever. And then these people, the baby boomers, had you lot, the millennials, and they're both in the labor force at the same time. And the millennial population was larger, not as a percentage of the overall population, but in actual cohort numbers. So what you did is you killed the American dream. You killed the dream of increasing productivity leads to increasing real wages. And the answer to that was debt. And so debt growth, and so that build-up in debt offset the inability to buy assets. So they basically, the balance sheet ends up working out roughly that households borrowed money to buy assets. What happened is that whole system became a debt-based system. And in 2008, we just hit the ceiling. Just the whole thing blew up. And it was the defining moment of our lifetimes. What had happened is governments around the world had got to roughly 100% of GDP in debt. Now, if you think about that magic formula, that GDP, the GDP growth is really what drives savings and investments and also pays the interest on the debt. Now, because GDP growth had been falling over the last 30 years, what you found is trend rate of GDP since about the early 2000s had fallen to about 2%. And interest rates were about 2%. Well, they were a bit higher beforehand. 2007, they were 6%. So what happened is there's not enough money to pay the interest. Because if you think about it, GDP is growing at 2%. You need to pay 6% interest rates on the government debt, which is 100%. But the private sector's 100 and something percent in debt as well. So what happened is the whole system broke. The answer to that was firstly cut rates to zero everywhere. And then it was quantitative easing. And it took me a very long time to understand what the hell this was all about. We kind of knew that they were injecting money into the system. What did it mean? How did it work? Nobody knew. We were arguing about it for a very long time. And it was only until really at about 2020 when we saw the next big wave of, so we had QE in obviously 2009, 10, 11, 12. Then again, I think it was in 14, and then again in 2019, and then a lot more in 2020. And it was observable that asset prices moved every time it happened, and the correlation was very tight. And we were kind of trying to figure out, was this causation, correlation? None of us really knew, but we could observe it. 2020 comes along, and it becomes strikingly obvious that there's a bigger force at play here. And I started to realize the force at play here was actually debasement of currency. So people have been expecting quantitative easing to be an inflationary process, i.e. the cost of goods rise, but they don't. The cost of assets rose because scarce supply things, assets, get readjusted in price when you lower the purchasing power of a currency. Now here it's not the dollar versus the euro versus the yen. We're talking basically all fiat currency. The value of it, because there's a lot more of it around, becomes less. And the quantitative easing was the supercharging of this process. So that was basically the defining factor of asset prices. And if you back it out, and we look at Global Macro Investor, my research service, we look at the G5 central bank balance sheets plus M2 for those countries, and we find there's a 97.5% correlation between the S&P and that. It's like, okay, so what we're doing is debasing currency. If that's the basis of the problem we now face, then let's look at things in those terms. So I started dividing the S&P by the Fed balance sheet or the G4 central bank balance sheets and all assets. And what you got was kind of a normalized world where the S&P had gone nowhere, really. Gold had gone nowhere. Real estate had gone nowhere. But two assets had gone up a lot. And one was technology and the other was crypto. That's when I started to understand network effects and understand the secular trends that drive cryptocurrencies and many technologies. And that was the whole thesis I started building about Metcalfe's law and understanding that. Out of that whole moment as well, I started focusing on the technology side of the equation. And I could see clearly when I looked at the data long enough and divided by the balance sheet and looked at it in various ways, there was something actually much bigger going on. So then I started digging in and I came up with this thesis of the exponential age, which I'll come back to, which was I realized we're walking into a nexus of network adoption effects at scale of which humanity's never seen before of numerous technologies. And we'll talk about that. Okay, so that was that thesis. This is what gave me a lot of the strength to understand what to do in crypto. I realized that crypto was a secular trend driven by network adoption and a cyclical trend driven by liquidity, i.e. the balance sheets, M2, those kind of things. If you lean into those, you get the big opportunity. My way of doing that was not by trading in and out of crypto. It was just by adding when it all pukes and everything goes horribly wrong and you're at the bottom of the long-term adoption trend channel, 2 standard deviations oversold. Okay, there's the perfect buy signal if you believe the network adoption continues. And that's worked for every technology stock from Amazon to Apple to Microsoft to everything. They all work the same way. It's like, and once you see this stuff, you can't unsee it. Secular trends, cyclical trends, the nexus, the magic nexus is really an amazing opportunity, which was last year in crypto and last year in exponential age technology and technology overall. What the everything code was me then starting to dig into a chart that I saw that the ISM was perfectly cyclical. Every peak in the ISM, which is my proxy for the business cycle, is 3.5 years apart since 2008. I looked at that and thought, what the hell is going on? Because we were used to remember that long cycle going into the 2008, the great moderation. And now suddenly, like clockwork, the peak of the ISM. And then as the ISM falls, hey presto, back comes quantitative easing. I'm like, okay, what's this all about? And then I stumbled into something that was quite remarkable. Is I looked at the increase in the balance sheets, the increase in GDP growth. Anything in excess of GDP growth was being monetized. But 3.5 years later. So then I looked at the debt structure of the United States and realized every single man, woman, child, corporation, and the government, and every government around the world, and every corporation reset all interest rates to zero in 2009. It was like a reset. And everybody's got roughly 3 to 5 year debts, and they keep rolling every 3.5 years. And what I found is the interest payments that the US makes, and the EU, and Japan and the UK were explained by the amount of quantitative easing that happens 3.5 years later. So what I'd suddenly stumbled across in the everything code was the fact that the global central banks had probably agreed together in 2009, 10, 11, 12, probably 2012 after Europe blew up, that with governments at 100% of GDP in debt, they were going to crowd out all the private sector and we were just going to keep having financial crises. And the only way of solving this was putting it on the central bank balance sheet because there's not enough GDP to pay the interest. So if you think about GDP growth, and let's make the maths easy, even though GDP growth is actually 1.75% trend rate in the US, but let's call it 2%. And let's assume interest rates are 2%, which is roughly where they've been since 2008. So if the government's 100% of GDP in debt, GDP grows at 2% and interest payments are 2%, that's all of GDP growth just to pay the US government debt, just to pay the interest on the debt. So, but the private sector, excluding the financial sector, so households and corporations, are another 120% of GDP in debt. Well, that will give you negative growth every year of 2%, and it just compounds. So what happens is those interest payments just go into the Fed balance sheet and they monetize it. So then the private sector is not competing with the government. And that was provable across all of the major economies. It's like they've all decided that they were too far in debt and the only way of doing this was quantitative easing. And then I started thinking, well, if I know this to be true, and I know that the central bank balance sheets are 97% correlated with the asset prices, well, all I need to do is use forward-looking indicators for the central bank balance sheets or interest payments. I can back it out a number of ways. And what I found is that I could build a model with Julian Bittel, who works with me, to forecast out the growth of the central bank balance sheet by about 18 months to 2 years. And it works almost perfectly. And then I backed it out a number of ways because I don't want to just rely on one indicator like, forward-looking indicators. I had been using for a long time the chart of the labor force participation rate in the United States, which is a function of demographics. And I found that it perfectly correlates with the Fed balance sheet and it predicts it going forwards because you know where demographics are going to go going forwards. And it got to this number where the balance sheet gets between 12 and 14 trillion by the end of 2025. Now, if I know that, and I can prove it out by the interest payments that we know are due, because we can see that in advance, and they come to roughly the same number, which is 12 to 14 trillion. Then I looked at it different ways. I looked at the trend rate in a log channel, and it would give you the same number at the same period of time, which is the next cyclical peak in the ISM. So if we look at that, and we know that it's the main driver of asset prices, we know where asset prices are going, which is why it becomes the everything code. Because there is no macro. It is all an interest rate cycle driven by interest payments because all debt got reset, which is why everybody has struggled since 2008 to understand the world. So then when you're seeking clarity in this world, and the world is actually the most simple it's ever been, money in, money out, that's it, then what you want to do is own the assets that rise the most and outperform that, which happens to be crypto and technology. So if we look at the last time we went through this point, which is the turn in the cycle, which is where we are today, that was December 21st, I think it was, 2018, when the Fed paused, which is roughly where we're getting to now. The market already knows this. It can see it coming. We're already having a banking crisis, all the signs of we need to stop. And what happened after that over the next year is the S&P rose about 15%. The NASDAQ rose about 25%. What I call the exponential age stocks, they rose about 35%, 40%. And crypto did, well, at one point 300%, but ended the year up about 100%, which is truly extraordinary. I've also then shown that crypto is all the same thing. So if I use the same global liquidity index, it's basically the chart Bitcoin. But Bitcoin outperforms in the up cycles because there's a network adoption model, which is why it does so much better than almost all other assets. So that's the everything code, is the fact that it's all down to one simple thing. And I think it's forecastable. And in which case we know the price of assets in advance, which is a little bit freaky. And I know that sounds somewhat arrogant, but it's a hypothesis that I'll test, but I'm pretty sure it's going to be right, unless something changes.
For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.